you quickly realize as you build a business or you build a real estate portfolio or you're managing a team that there's a lot of other individuals that can do it better than you. And even if they can't do it better than you, you're going to do better as a whole as you bring those individuals in.
Welcome to The Real Deal, a commercial real estate investing podcast. I'm your host, Aman. There's a ton going on in the world right now, and much of it impacts real estate investors. The Real Deal podcast will take a look at what's happening and how it influences you as a real estate investor. Each episode is a 20-minute segment dedicated to distilling the day's most important news, so you can stay up to date on what's going on in the world and how it might affect the commercial real estate market.
Welcome back to another episode of the Cashflow Capitalist Show. Today we have another very special guest. His name is Michael Roeder. Hey, Michael, welcome to the show.
Thanks so much for having me on. I'm excited to be here.
All right. Introduce yourself in 30 seconds and tell us who you are.
Got it. So I live in central Minnesota. Name is Mike Roeder. I live up here with my wife and my two daughters. And I got involved in the real estate industry back in 2009. We started picking up some single family rental properties, house hacked my first house. And eventually that led to some burnout. We can probably talk about that more in just a minute, which led me to really analyze what area and what niche of real estate I wanted to be in to create financial freedom and to build up my passive income. So eventually I shifted over to multifamily investing about 7-8 years ago. And we started picking up multifamily projects in the Midwest. And then eventually we shifted down to Dallas, Fort Worth, and Nashville. Now that's all we do. We have about 2,500 units under management, and we focus on B and C class multifamily assets.
And before real estate, what were you doing? Like, what kind of job were you doing? Or you just straight went to the entrepreneurship?
No. So I was an insurance agent. I worked with high net worth individuals. I did that for about a decade. And it was a great career, but I was tied to a desk. And, at that same time, I was hustling, trying to build up my real estate portfolio so that way I'd have the potential to step away from that career. And about 3 years ago, I finally fully stepped away from that career.
And did those connections with the high net worth also help you in getting the real estate? Or did you leverage them? Or you just I cannot use them because I was working there, I got it from them, and I cannot use them?
That's a great question. So I have interacted with some of those individuals over the years, but that did not propel me into the space.
So tell us about your single family story then.
Yeah. So single family, I purchased my first house when I was about 20 years old, was dating my now wife of 14 years. And we purchased a 4-bedroom house near campus. We were going to St. Cloud State University, so a university in central Minnesota. And we rented out 3 out of the 4 bedrooms. So we lived in one, rented out 3 of the bedrooms. Property was cash flowing. It was paying for our mortgage, our utilities. And we kind of fell in love with real estate at that point. So eventually we turned that into a full-blown rental property. We picked up a handful of other single-family rental properties. The problem was, I was living about an hour from my rental properties and another hour from my corporate position. So I would commute an hour to my corporate position, commute an hour home, and then go up to my rental properties because I was self-managing them. I was doing all the evictions, doing the leasing, doing the maintenance, so that way they could cash flow. And it created a little bit of burnout. It's like, why am I adding the second job to my plate when I'm cash flowing, $2,000 to $3,000 a month tops? So eventually I sold those off and decided to get into multifamily where we could really have some scale, get the economies of scale, hire third-party property management. So that way I wasn't in the weeds doing all the day-to-day operations. And that's worked out, tremendously well compared to the single family space.
And it's the same concept of the book, that who, not how. Like, don't try to do everything. Don't try to figure out how you're going to do it. Find somebody who can do it for you. And maybe your cash flow went down a little bit, but you're going to sleep good.
Yeah, that was crucial for me. It just was not working to do everything. And that was my mindset, growing up. I'm going to do everything on my own. I'm going to get it done. I can, potentially do it best. And you quickly realize as you build a business or you build a real estate portfolio or, you're managing a team that there's a lot of other individuals that can do it better than you. And even if they can't do it better than you, you're going to do better as a whole as you bring those individuals in.
Because I want to share my story too. I met this person. He said he has some Airbnbs and he's managing himself. And he was managing himself, and he was making like 10 to 12% of the cash flow. But that's still pretty good. When he hired somebody, he's like, I'm learning from him that how to make 18, 19% when you hire a property manager. I'm like, let him do. At least even he's making money from you, he's still giving you more return. But people don't want that. I want to do by myself. And now they're all burned out, but they don't want to invest passively. They just like, I want to do everything by myself, but they never take an action.
Yep, exactly. You see that a lot out there. And, if you can get around that mindset and realize that you can go further with, additional people or a team, you're going to go that much quicker and that much further in life.
And I think that's more consumer mentality, not investor mentality. That you want to do everything by yourself, because I've seen mostly wealthy people who have like big businesses. They find people to invest their capital in. When they invest, they're like, yeah, build me a passive income so I can focus on my one job.
Yep.
Or my one business I have. And also people say that average millionaire has like 7 streams of income. It's not like they were working 7 streams of income at the same time. They were working on one and they were building 6 other passively.
Yep. I completely agree. And I think about my personal portfolio. I'm invested mostly in multifamily. The bulk of my, investments are in multifamily, but I do have some other investments, in the stock market, in oil, in crypto, and in those other spaces. I like to allow professional individuals that are very knowledgeable in those subjects, in those fields, to help me place that capital. Just because I don't have the time and the energy to become an expert at that field, and even if I did, it would take years and years of experience to get to that level. So I think that's crucial.
You cannot be expert of everything. You need people. If you learn how to leverage the labor, you can make a lot more money. Yeah, like you're not gonna be the smartest person in the room. It's okay. Like you don't have to be. You just have to be the richest person in the room.
Yep, very, very crucial.
So, what are the challenges you are facing when you have to move from single family to like multifamily?
Yeah, that's a great question. So when we moved to multifamily, it went pretty quick. We found a project actually in our hometown, central Minnesota. We acquired a 20-unit project, then we acquired an 8-unit project, and then a 12-unit. And then we formed our company, Granite Towers Equity Group, in 2017. And that's really where we started to do it correctly and to get the education to really understand the space and do it well. So we started syndicating projects, which means pooling people's capital together to buy bigger, better projects in potentially better markets. And I think looking back, the one mistake that we made is we invested in our backyard because that's what we knew. We didn't, know Dallas, Fort Worth, or Nashville, or these other hot markets. We knew central Minnesota because that's where we grew up. That's where we lived. And, looking back, I wish I would have skipped that, taken a little bit more time to understand different markets and to understand what is crucial when you're underwriting a deal. And I can tell you, we would have done much, much better on our returns on those first few projects. Because those first assets that we invested in, great property on a spreadsheet, but when you actually took a step back and looked at the market was not growing, and it was very tied to a college, and the enrollment in that college plummeted over the next few years. So we saw our occupancy drop, and that affected the value of our assets in that location. So location is huge, and that's one of the 5 pillars, that we really focus on when we're acquiring a multifamily asset.
And what are the other 4 pillars?
Yeah, great question. So one of the pillars is the debt. And so all 5 of these pillars are very, very crucial in order to make a project successful. So you have to have the right debt on the project. And what that means is you have to put the right loan in place. And that's where you're seeing a lot of the distress in the market right now, because there were a lot of short-term bridge loans put in place that had variable rate interest rates, and people aren't able to pay their debt right now, or they're not able to refinance or sell, and they're stuck, losing the property, and losing some of the equity or all of the equity because they had that short-term debt in place. So for us, we're fixed rate debt investors. We place fixed rate debt on our properties so that way we can weather through an economic downturn if we need to. The general partnership team is also crucial. Those are the people that are steering the ship from day to day. They're asset managing the deal. They're implementing the CapEx plan. And you need to have a solid team with great synergy that has experience overseeing the asset. And that's going to really, help you become more successful. Like I said, the location, that is absolutely crucial to get the location right. Because if you don't get the location right, there's not a lot that you're going to be able to do. So a few things that we're looking at right now, we're looking at areas that have very low delinquency or properties that have very low delinquency. So for instance, we have a project right now that we're working on in Dallas, and the delinquency over the last 12 months is 0.52%. So less than 1 percentage point of the property is delinquent on the rent over the last 12 months. And that's what we're looking for, a property that we can step into, and we're not going to have a ton of issues evicting tenants and trying to get tenants to pay. You also want to make sure that the income supports, the rent levels. You want to make sure that it's not in a war zone so that you have, a nicer area that has good businesses, good walkability, good crime score, good schools. That's all crucial as well. And any questions that you have on that before I go into the other pillars?
I have a question on the debt. So since we seeing like interest rates has increased so much, what kind of debt are you focused on more? Because even if you talk about fixed, you're still not getting like at least like 6 to 7%, and that's bringing the cash flow so less. And even sellers are still not realizing there's a lot of distress in the market. What do you want to say about that?
Yeah, that's a great question. So we are continuing to place fixed rate debt on our properties. And if the property doesn't make sense financially because the interest rates are a little bit higher right now, then we're passing. We're on to the next opportunity. And, over the last 12 months, we've analyzed 293 assets in Dallas, Fort Worth, and Nashville. And we've offered on 8 properties. So 8 properties out of those 293 have hit our metrics. And we're just working on our 3rd asset that we're acquiring this year. So we're looking at a lot of opportunities to find the needle in the haystack because of that reason, Aman, because the interest rates are higher and it's just harder to get a deal that actually cash flows. And to your point of, pricing dropping and sellers maybe not realizing that their values have plummeted, we're starting to see that change. So we're starting to see the gap in between where the sellers are at and where the buyers are at close, and more deals are getting done. And we've seen pricing decrease by about 25 to 30%. And that's where the market is right now because of what interest rates have done.
So 25 to 30% in Dallas, Fort Worth.
Yeah, and we're seeing that in multiple markets. So really across the nation, 20 to 30% delta is how much the values have decreased because of the interest rate.
Because sellers are becoming now motivated sellers because
Correct.
They would have to sell.
Yep. And I think that's, there's a couple of reasons for that. First off, there's a lot of sellers that need to sell. And so they're realizing, hey, we're not going to be able to get an offer here. And then there's also the sellers that, are still able to make a good return, and maybe they put it out to market, but they're just realizing very quickly that all the offers that are coming in 20 to 30% below market. So they're coming to that realization that, hey, do we want to cut our losses and sell for this price, or do we want to continue to hold?
Got it. And what are the other pillars?
Yep. So another pillar would be CapEx. So coming in with the correct amount of CapEx and the correct business plan. And you see this time and time again where general partners come into an asset and they underfund it. They don't have enough funds for the CapEx that needs to be implemented at the property. And not only that, if you plan on holding it 5 to 7 years, you're going to have some CapEx that's going to come up, over the 2nd, 3rd, 4th, 5th, 6th year of ownership that you're going to need to take care of. So I think it's crucial to come in with more money than you expect to use and have that buffer, have that variance. And try to take care of the deferred maintenance and the issues right off the bat if you can. So that is absolutely crucial to us. And then the last piece is the actual team surrounding you. So your CPA, your cost seg specialist, your legal team, your property management team. I mean, that is a crucial piece, is to get the property management team correct. And then just make sure that you have synergy with the on-site team as well, because if you don't have a good on-site team, it's very, very hard to do well on a property.
Does it ever happen with you when you try to talk to new investors or new different kind of entrepreneurs who are not in real estate, and they say that, so you're a property manager? Because that happened with me last night. I went to this startup event. I was telling people what I do. They're like, so are you are a property manager? I'm like, no. We manage property management. Does that happen with you?
Every once in a while, I think if you get, individuals that aren't sophisticated with real estate investing, they get the two confused, but you can explain the difference, pretty quickly. That there's third-party property management. They oversee the day-to-day operations. And then there's, an actual syndicator or an operator or an asset manager that oversees the third-party property management team, oversees the CapEx spending, oversees the business plan. You're really steering the ship. You're the CEO of that property.
So when you acquire the property, what's the first step do you focus on more? Yeah, you close on the property, and what are you first 2 or 3 steps that you more focus on more?
Yep. So there's actually quite a few steps that go into the equation before we close on the acquisition. So number one is getting our team right. So we want to make sure that we have the on-site team members hired and ready to go for day one of operations after we close on the property. So, and a piece there is, try to hire A players, try to hire the best of the best. And if you need to budget some more for your payroll to get the right people into the asset, it's going to pay you tenfold. So that's absolutely crucial for us. Number two is compiling all of our CapEx bids. So what we typically do is we're working from the day that we put the property under contract to the day that we close on compiling at least 3 bids for every single one of our rehab projects. So that way, when we acquire the property, day one or within a couple of days after closing, we can have our contractors, our subcontractors, our teams on the premises diving into the CapEx projects and knocking those out of the park. So that way we can implement our business plan, push the rents, push the income on the property a lot quicker. So I would say those are a couple of things that we do right off the bat and that actually start before we acquire the property.
And if you talk about asset management, after acquiring the property, how often do you talk to your property manager? How do you see the KPIs? How do you what are the KPIs do you go through every single week after acquiring the property in the first few weeks?
Yep, that's a great question. So we always do a weekly phone call with our management team. So we'll have our regional manager, the on-site manager, our asset manager, and then typically, owners of our company on the call as well. And that can last anywhere from 30 minutes to an hour and a half. It depends on the asset and how it's doing. And you actually want to start that before you acquire the asset. So that way everyone is in tune. Everyone is on the same page when you step into that deal day one. But we go through a lot of KPIs. We have a very robust spreadsheet that we built out over the years. And, there's things as simple as occupancy. And there's, other KPIs like delinquency, your 30, 60, 90-day delinquency, your number of applications that came in, how many of those applications were denied, how many were approved, how many leads, transitioned to showings. There's just so many KPIs that we take a look at and that we monitor on a weekly or a bi-weekly basis.
And if you talk about property manager, when you acquire the property, do you bring your own property management company or your third party, or you use the current one?
So we typically use all third-party property management. And we have a couple teams that we've built out some really good relationships with over the years. But going back to when we break into a market. So when we went into Dallas-Fort Worth and we're like, hey, we want to buy multifamily assets here. We know the areas. We know this is a good market to invest in. We basically spend a week to 2 weeks in that market interviewing management companies. And a few things that we do to vet the management company include, number one, visit their corporate office, get a good feel for what their team is like, what their training processes are like, what their office looks like. And then you also want to go and visit their properties that they manage. Go and drive 5, 10, 15 of their assets and see how they look and they feel. Are they upkeeping them? Do they look clean? How is their staff? Ask them for referrals. So other GPs or general partners that they manage for, and call those people and talk to them about their experience and ask them, what would you like to see done differently by this management company? And that'll really open up the door for their weaknesses. And those general partners typically will share those weaknesses when you word it that way. You also want to take a look at sample reports, financial reports. You want to take a look at their online presence, their online reviews. There's a lot of different things that you can make sure that you're vetting the property management team properly.
And can you share any story where you had to change or face a bad property management and you had to change it? And does it ever happen with you?
It has. It's happened a couple of times on different assets, and the commonality is that we see again and again in the industry is some of these property management teams, they grow too quick and they don't have the systems and the people in place for the growth that they're experiencing. And so what'll happen is you'll find a great management company, everything is in check, you'll hire them, and then all of a sudden, a couple of years later, things start to fall through the cracks. They don't have enough employees, or they don't have the systems, or they don't have the accounting department that they need. And, sometimes you can't coach it. You can't bring on additional team members to fix that issue. And so we've had that a couple of times where we needed to switch management companies. A recent switch happened because of the accounting department. They couldn't get bills to paid. Vendors weren't coming out to the property. They were quitting on us. We were having a hard time turning units, and that was all because of the accounting department, because they wouldn't pay the vendors on time, even when we would request it multiple times. So you just need to be in tune, and if you see a red flag like that, try to fix it, but also move quick to fire that asset or that property management team and get someone new in. And a tip here, if you're in that situation, I would strongly, strongly recommend doing a hostile takeover. So essentially, if you're going to fire a management company, don't give them a 60-day notice, wait 60 days, and then have the new management company step in. The day that you give them notice, have the new management company step in and start managing the asset. Because if you don't do that, you're going to lose 60 days of runway, and your property is going to continue to slip. They're going to take their foot off the gas. And you're probably going to have to pay both management companies for a couple of months, but it's going to be well worth it.
So hire fast and fire faster.
Yep, exactly.
So have you done any kind of, how do I say this, unconventional way to increase NOI beside renovating the units?
Yeah, we have quite a few different, options that we take a look at every asset, and each asset is different. So, for example, we had an asset in Nashville where the gym was ginormous. It was an A-class asset. We split the gym in half, and we created 7 offices, so mini offices for the residents. And there's a lot of people working from home these days, so we were able to rent those offices out for about $800 a pop and increase the value of the property significantly. We've also done things like, carports, garages, storage units, bulk Wi-Fi, owning your own laundry machines, renting laundry machines back to the in-unit tenants. So there's a lot of different unconventional ways that you can boost NOI or income on property level.
Anything with the green technology like solar or something like this?
We've looked into solar multiple times. We have not gone that route for solar panels. It just hasn't made financial sense. Now, I think it's becoming more and more attractive, and it depends on what market that you're located in. Because, for instance, Texas, electricity is fairly inexpensive, so it makes it hard to make it worthwhile. Whereas other states, your electric is much higher cost. So it's going to make a lot more financial sense. We did put in some electric chargers for electric vehicles at one of our A-class properties in Nashville. It doesn't bring in a ton of income, but it brings in some income. But the other nice thing is it attracts tenants. So you're bringing in prospective tenants to the property, and you're also getting, other people off-site that come there just to charge their vehicle, and they see how nice the property is, so they're attracted to the asset. So it's a leasing tool as well.
Got it. And so, as we know, the economy is going different ways, and how hard it is to raise a capital nowadays.
Yeah, it's the toughest I've ever seen it. And it may have been this tough, back in 2008, but that was right when I was getting my start in the single family space. So there's a lot of fear in the market. Obviously people are unaware of what's going to happen with interest rates, what's going to happen with inflation. Are we in a recession? How long is that going to last for? So I think the biggest thing right now is educating investors why now is the time to buy. And you get that with any industry. Whenever there's a big dip, a big downturn, people want to hold tight to their cash. They don't want to invest. And it should be the exact opposite. They should be holding tight when the values are up here and sticking their money in when it drops out like it has right now. So a couple of things that we're talking to investors about, again, pricing, the reduction in prices, 25 to 30%. I mean, that is a huge, huge reduction in price. And then a couple of other things that really stand out to me right now, the affordability gap is at an all-time high. So there's a gap of $1,291 per month right now in between having a mortgage and owning a house compared to renting. And that is the largest it's ever been. It's about 60% higher than what it was in 2006, 2007. So you have a lot of people that are stuck renting, apartments and homes because of that stat. And then also, vacancies at 5.7%. That is super strong, across the nation. And there's other markets that are even better than that. And then construction starts way down. Construction starts have plummeted by about 50%, since this time last year. So what we're experiencing right now is we have a lot of supply coming online right now in 2023. But as you move into the end of 2024, 2025, 2026, that new supply is going to dip dramatically. And what happens when that happens is there's an increase in demand and you see a lot more rent growth. So there's going to be a ton of pent up demand, a huge housing supply and apartment supply issue, coming down the pipeline. So that's good for apartment investors. And then the last piece is the institutional capital and the retail capital sitting on the sidelines. I mean, there's about $230 billion of institutional capital sitting on the sidelines, waiting to come back into the industry. And then you have a lot of retail capital as well. So as soon as that happens, it's going to push the values of these multifamily assets up because there's going to be so much competition in the industry. So it's key to try to get in before that happens, which we think that's right around the corner.
And do you think that will also bring the rents up and also increase inflation again? So that will make Feds to increase the interest rate again, because that's what happened in the 1980s too.
Yeah, I think, with inflation, it's so hard to say, but I'm not sold that inflation is 100% tamed. I mean, I know CPI came out the other day. It was a little bit lower than expected. And so people are thinking that interest rates are going to be cut, but inflation is, completely controlled. I'm not sold on that. So, again, what we're doing is replacing fixed rate debt. So that way, if interest rates do go up in a year or 2 years from now, we're protected from that. Now, I do think it's fairly likely that we might see a pullback over the next 6 to 12 to 18 months where interest rates come down a little bit. But I think that there's a chance that they could ramp up after that, because of the inflation issues.
And there are so many investors who just holding capital to invest, to deploy. The moment something happens, jump on it. And so what are you saying about the rent increase? Is it going to, what are we seeing in next 9 months? Is it going to keep increasing or stable or come down?
Yeah, that's a great question. So I think rental increases or rent growth is going to be pretty steady over the next 6 to 12 months. So some markets, you're going to have a little bit of negative growth. Some markets, you're going to have 2-3%. It really depends on the submarket and the market that you're in, but it's not going to be substantial like it was over the last couple of years. I mean, we were seeing 15 to 20% rent growth. That's not normal. If you take a look at the historical norm, it's 4 to 6% typically. So what we're projecting is over a 5-year period, an average of maybe 3 to 4% tops. And again, I think it's going to ramp up over time. I think 2025, 2026, 2027, you're going to have some really nice rent growth. I think 2023, the rest of 2023 and 2024 is going to be, pretty minimal as far as rent growth goes.
Got it. So before we wrap this up, I have two or three more questions. What do you want to say to those people who want to get into multifamily? They're totally new into real estate.
Yeah, so a couple of things. First off, get educated. Try to learn as much as you can. You don't want analysis paralysis, but at the same time, you need to know what you're looking at. And then I would also say, try to find a general partner that like, and trust, and that has a solid track record, that has some referrals that speak highly of them, and try to latch onto those people, invest with them, see what they're doing. If you're planning on being a general partner, then invest in a handful of projects and see how they operate, see where their shortfalls are, see, what they're doing really well at. And then if you're just looking to passive invest, I think there's a few things that you need to do. You need to vet out the sponsorship team, like I just said. You need to vet out the location, make sure that you're investing in a good location. And then you need to be able to analyze a deal yourself as well and take a look at the numbers and understand what they mean, because the smallest tweak on a spreadsheet can make a big difference on the returns, and you need to understand that.
Got it. And what books do you recommend to somebody who's totally new, either real estate or mindset?
Yep. So I would say the ABCs of Real Estate Investing by Ken McElroy. Very good book. Explains the principles and, the general information about apartment investing. So I really like that one. The Power of One More by Ed Mylett. Great book. It's fantastic as well. We actually just did a podcast on that on our top 10 takeaways. So if you take a look at Keeping It Real Estate Show,
I need to read that one.
We have a podcast on that. And then also a book that I read to my daughter called Shoe Dog. And that's a book on Phil Knight, the owner and founder of Nike. Is just a fantastic book on persistence and being resilient, regardless of what career you're in.
I've listened to Ed Mylett in person, like on a conference. I need to read his book, but I'm following on Instagram and following on a podcast. I need to read his book because I love reading than listening.
Yep, I completely agree. And if anyone out there hasn't, seen Ed Mylett in person, he is outstanding. Just such a phenomenal speaker. So,
yep. And if today is the last day on this planet, what message do you want to give to the world?
Gosh, what message? I would say educate your children, educate them on mindset, educate them on investing, educate them on the power of financial freedom and passive income, educate them on pushing themselves and others. There's a lot of subjects that aren't covered in school, and I think we as parents need to really dive into that and educate our youth a little bit better. So that's been super important for me and my wife and our two daughters. And I just get so excited when other people are doing that out there.
Got it. And if somebody wants to reach out to you, where can they reach out to you?
Yeah, so you can go to our website, granitetowersequitygroup.com. And if you go to the Contact Us page, you can fill in your information. That'll get you on our database, and then we'll reach out to you to schedule a call. We also have some goodies on there. We have a free ebook, our podcast as well. And then we can send you a passive investment tracker for free as well. So just notate that when you fill out the Contact Us form.
Got it. And thank you so much, Michael. Thank you for your time and wisdom. And I'll see you another one.
Thanks so much, Aman. I had a blast. I appreciate it.
Thank you so much.
Thank you for joining us on The Real Deal, a commercial real estate investing podcast, the show that covers everything to do with multifamily real estate investing to help you become an expert in your real estate ventures. We're here to help you create passive income and financial freedom so that you can achieve what you want whenever you want. We'll catch you next time on The Real Deal.